Okay, thank you for your patience, ladies and gentlemen. As I said, my name is Tom Foster, and I'll be your moderator today. Before we start the actual presentation, I'd like to go through some housekeeping elements with you. So if we could show that slide, DJ. We're going to handle all questions at the very end, but questions can be submitted anytime during the webinar by clicking on the questions tab. As you can see here, it shows you where to click on your computer. Also, all participants are on mute, as you see. At the end of the webinar, please complete our brief survey. Your feedback helps us improve our seminars. A replay of today's webinar will be available on the DCIU webinar archives as well as on 401k TV. I also might want to mention the fact that this program qualifies for 1 hour of SHRM credit as well as HCRI credit, and it also qualifies for a CKP credit for 1 hour. Now, for those of you who are looking to receive HRCI credit or SHRM, please stay on the call after it ends for approximately 1 minute, and we will give you a code necessary to complete your 1 hour of credit. So as we start the program, I'd like to, first of all, welcome you, all the audience. I'd like to also welcome the organizations that are sponsoring today's call: DCIA, Spark, TPSU, and TROW. My name, as I said, is Tom Foster. I'm the Managing Director of the TROW Speaker Bureau. My esteemed panelists that are joining me today are David Blanchette, Head of Retirement Research, Morningstar Investment Management. We have Joe Denoya, President of Washington Financial Group. We have Leanna Magner, the partner of U.S. Defined Contribution and Financial Wellness leader at Mercer. And then we have Sharon Scanlon, Head of CX, Individual Life Annuity and Ops, and Retirement Plan Services at Lincoln Financial Group. Now, before we start, let me just give you a brief overview of what we've done so far. This program is actually, this virtual town hall is part of an ongoing series of webinars aimed to help you deal with the ever-changing landscape of retirement plans and investments due to the onslaught of COVID-19, the passage of the CARES Act, and of course, the SECURE Act. And we've heard from advisors, plan sponsors, record-keeping, HR specialists, and industry trade representatives. They have discussed a multitude of issues affecting you and your participants. As a matter of fact, the last town hall we did in conjunction with the DCIA and Spark was a memorable one because that was the day the CARES Act actually passed during our webinar. We had a lobbyist and an attorney from Washington who discussed the bill and how it came to fruition and the legal implications. We had a representative from the U.S. Chamber of Commerce who spoke to some of the specific provisions within the CARES Act. And we had DCIA's own Peg Knox, who discussed some of the issues she was dealing with in conjunction with DCIA's 185 member organization. Today, we're going to take a deep dive into QDIAs and how they have fared during this time of trying times. So David, let me come to you first. In your presentation, could you please address the performance and participant behavior in Q1 of 2020? Specifically, were there any differences in behavior among participants in QDIAs and those who manage their own portfolio? Were there any differences in behavior among the age groups? And as you start, David, why don't you give us an overall view of the performance?
Sure thing, Tom. So on the next slide, it's no surprise to any of us that the first quarter was a pretty wild ride for equity investors. If you look at U.S. markets down between 20 and 30%, international, it's really not a pretty picture, right? The one asset class that did great was long-term bonds, but most people invested inside 401k plans, have about 75% of their portfolio in equities. And so again, it's no surprise they're probably going to see a loss this first quarter. On the next slide is kind of some idea of what the losses look like. And so what you're seeing here is what was the equity allocation for, this is about 600,000 participants. As of December 31st, 2019, what was their balance at that date, and how do they do in Q1, right? What's really important is you could actually have some participants who are invested very aggressively that actually have higher balances. And what happened there is just cash flows. Right, so participants that have larger balances and more aggressive portfolios saw the largest declines. Right, so again, some participants who maybe have who are older and have more conservative balances could have seen a decent rise. But for the most part, when participants after they've received statements, they're going to show a loss. And as this has been going on at Morningstar, we went asking ourselves, well, who is responding to these losses differently? And so on the next slide is kind of what I want to talk about today is our latest research kind of exploring participant behaviors during the first quarter of 2020. For the next few slides, what we're looking at here is data on about 600,000 participants who were enrolled in a 401k plan, both as of 12/31/19 and 3/31/20. For the research, what we're looking at is changes in allocations. And what I want to talk about today is the initial research. I'm actually working with Michael Finca and John Reuter on an updated version. But the key here really is asking, how did participants behave differently in this time of market volatility? And I think, one of the most important things to think about, especially now, is how participants are invested, right? So on this slide, what you're seeing is the distribution of participants across kind of 4 different investment types as of December 31st, 2019. That blue area is folks who are self-directing. The red is people who are using a target date fund, and then the orange and yellow is managed accounts, whether they were defaulted or opted in. And what I think is most notable for me here, and this will actually be a reoccurring theme, is notice how that group of self-directors increases significantly at older ages. Right? Only about 17% of participants who are 25 or less are self-directing. Right? It's almost half by the time someone gets to age 65. And this ends up being relatively problematic. Now, on the next slide, real quick, is just an idea of the distribution of equity allocations for the participants. Not surprisingly, what we see is the biggest band of equities is for self-directors. Self-directing kind of terrifies me. People that are building their own portfolios just is not something that I like to see, because they do crazy things. Right? And if we kind of look across the spectrum of what about the professionally managed solutions, TDFs, default managed accounts, and opt-in managed accounts, the equity allocations kind of, increase by dispersion as you move from a target date fund, which is, relatively not customized, and then as you kind of increase customization or personalization, you get, wider bands of equity allocations. Well, on the next slide is kind of, to me, one of the most important points, which is, who made a change, right? Who went in and said, I don't like my portfolio, I'm going to do something. And what we see is only about 2% of participants who have delegated investment responsibility to either managed accounts or a targeted fund made any kind of change at all, right? People who are doing it themselves, those self-directors, about 17% went in and made a change. Right, and these are levels that we typically see annually or less. Right, what's really interesting though is the group that made the most changes were mixed TDF investors, so individuals that are combining a target date fund with core menu solutions. Almost a quarter of those participants made some kind of change in their portfolio in the first quarter. Now, it's obviously too early to know whether this was good or bad. But again, to me, this is not what you want. You don't want participants going in and trading, because almost every paper shows that over the long term, this hurts them in terms of long-term performance. Now, on the next slide, we kind of ask this question, well, what participants are actually making changes? And it's really interesting because the effect is actually very different if you look at those who are using professionally managed solutions and those who are self-directing their portfolios. Right? If you look at people who are self-directing their portfolios, it's people who are younger, who have lower salaries and lower balances. It's actually the opposite among folks who are in professionally managed solutions. But the key here, it's so much lower. Right? So, again, if we just pick a number and say, well, 10% of people who self-direct make a change, the important question is, well, what are they doing and how does that vary? And on the next slide is kind of, at least for me, the most important takeaway here. What I'm showing you here is for different age groups, and this is as of December 31st, 2019, and equity allocations at that same point in time. What is the average change for these different groups? Okay, and what is absolutely startling for me is the differences that we're seeing in behaviors for younger participants and older participants. Right, so well, the green shaded area is younger participants. So if we go kind of the very far upper left, the average change in equity allocation for someone who was in equities less than 10% was an increase of 92.4%. Okay, what this means is the average person who is under the age of 25 that changed their portfolio, that was invested almost entirely in bonds, went all the way up to equities. Like, I love seeing that. I mean, you know, I don't like the idea of market timing, but these participants were not afraid, okay? They were doing the thing that most people can't do. They were trying to buy the market when it was less expensive. Okay, now, if we go all the way down, then what we see is this effect where the positive changes among people who are invested conservatively decrease significantly at older ages. Okay, now if we go all the way over to the far right and look at people that were invested aggressively, we see a similar kind of effect where people that were invested very aggressively and were younger didn't make a very large change at all, hardly changed the allocations. Older participants, though, made significant changes. They were the most likely to, you know, reduce equities by 50 or so percent. Okay, what's going on here? Older participants that make changes, make significant changes, likely negatively affecting their wealth. Okay, and if you remember that previous slide, these are the folks who are most likely to self-direct. And so to me here, this issue of who is self-directing, who's making changes, has important implications for, you know, the goal to get people using professionally managed solutions. Now, on the next slide, there is some bad news here, and I'm really curious to see how this works out over time, but there is an effect where participants were accepting the default investment less throughout the quarter, right? So what I'm curious to see, what happens next? And we've always had a huge rally, you know, in the month of April, but what we see, especially on that second slide, is that participants who are older reduced acceptance of the default by over 10% throughout the quarter. So again, participants who have the most money, who are the closest to retirement, are the ones who are less likely, it appears today, to use the default than they were 3 or 4 months ago. So on the next slide, to summarize, you know, participants were making changes. You know, I actually got an email before earlier today from someone at Morningstar kind of asking, you know, how does this compare to 2008? And my response was, it's kind of apples to oranges, right? Because back in 2008, we didn't have mass acceptance or availability of professionally managed solutions. We have that today, right? And because of that, people who use those options are making what I would call much better choices right now when it comes to trading, because they're not trading, right? We saw participants who are using managed accounts, who are using targeted funds, aren't making changes in their portfolios, right? What worries me, though, is what older participants are doing, right? They're the ones who aren't necessarily more likely to make a change, but when they make a change, it's relatively extreme, right? If they're invested aggressively or too aggressively, they become very conservative all of a sudden. And what we've seen is if someone did that during the first quarter, they have realized a pretty significant loss given the gains we've again experienced over the last month or so. And then finally, to me, this is more of a longer-term concerning trend, is the reduction in default investment acceptance among participants. I hope that this changes. My guess that it might, given how well things have done over the last month, but you know, if you don't go back and make participants, you know, revisit that decision, I'm worried that, you know, we have more folks opting out. It may kind of stick with us over a longer period. So with that, I'll turn it back to you, Tom.
Thank you very much. Very insightful, David. And I think next we'll go to Sharon. I think, Sharon, you can really chime in on some of the things David said and with the follow-up questions. But in your presentation, would you discuss whether most participants are staying the course in the TDF and QDIA solutions? I think that's very important, especially based on some of David's statistics. And was there a spike of flight to safety for ages 60 plus from mid-March to late March? And finally, is it important to offer a comprehensive QDIA, TDF continuum?
Great, yes, happy to. Happy Friday, everybody. Moving on to my first slide, I do want to talk about some of the observations we are seeing across our participant base around target date fund and QDIA solutions. In general, across the board, we've been monitoring market trends around asset allocation changes, savings rates, money flowing out, and other key indicators that we hope in short-term cycles do not permanently hurt that participant for the long term and even in the short term as they approach retirement. So just as David said, if I dig into the target date fund space in QDIA, Mostly participants are staying the course, but as we looked at diving deeper into these investment strategies, from mid-March till the end of March, we absolutely saw the group 60 plus, which were coming out of a target date / QDIA solution. And we did see age 60 not only a flight to safety around self-directors, but even coming out of the target date type solutions, and the age 50 to 59 group following them behind. So the younger age group, we definitely saw less transfers, but we also look at things like trends on enrollment for new enrollees. We monitor this month over month. And we did see that 79% to 80% of new enrollees, this is not auto enrollment, but active enrollment, are absolutely opting for the default investment, which is most likely a target date type solution. We did see a slight decrease upon enrollment to 77%, which I don't consider statistically valid, but also keep in mind if they're new enrollees, the demographic is not typically the 60 plus category. However, another interesting behavior that we've noticed through March and April is folks looking at their retirement income projections. So on average, we see about 30%, 30 to 35%. And through this time period, we've had people running alternative scenarios up to 57% of the time. So let's move on to the next slide, and my last slide, to talk about how does this drive personalized solutions so that we can drive the right level of outcomes, and how we use these behaviors to inform product innovation. We believe that you need to have a full suite of target date solutions and managed accounts. That has not changed over the last several years. However, we've had a lot of discussions during the Secure Act and post-Secure Act about really that in-plan guarantee partner with the managed account and custom target date solution. We see those solutions across the industry, but we're hoping with the safe harbor that we can gain more traction utilizing this type of guarantee that will hopefully, when the 60 plus or 50 plus see a market cycle having a downturn, having that locked in guarantee of income helping to mitigate that flight to safety, because that safety is within their managed account or their custom target date portfolio. With that being said, we'll turn it back to you.
Thank you very much, Sharon. And as you said, we all understand that during this crisis and all interacting with webinars and Zooms, we do encounter certain inconsistencies, and that it's to be well expected and definitely well received. So let's move on to you. Before you begin your presentation, could you frame your remarks by stating the average plan size you advise on? And then relative to the presentation, could you address the current target date universe and the usage of target dates as a QDIA, and the highlights and changes to the glide paths over the last decade? And next, could you comment on the performance of the near retirement funds today versus 2008 and why?
Sure, thanks, Tom. So again, I'm Leanna Magner from Mercer. My focus historically has been consulting to large and mega plan sponsors, and so my comments are focused on that market today. So if we flip to the next page, we'll start with some survey statistics. So according to Profit Sharing Council of America, 75% of plans of all sizes use target date funds as the qualified default investment alternative. For large plans with greater than 5,000 participants, that number is even higher at 91%. And that compares to about 50% back in 2008. So given that there's such strong usage of target date funds as the QDIA in the large market, I'm going to spend some time discussing the target date fund marketplace in general and some key trends that we've seen. Mercer conducts a quarterly survey of off-the-shelf target date fund providers, including both mutual funds and collective trusts. Our most recent survey covered 64 target date fund programs across 27 managers with over 2.2 trillion in assets. And so from that survey, you'll see the top 4 target date fund providers managed 74% of the assets surveyed. That's a statistic that has remained relatively consistent. So even though we've seen more target date fund providers come to the market over the last 10 years, the assets continue to be concentrated among the top providers. Another trend we've seen is a movement towards passive providers. So the current market share of passively oriented target date funds is 55.6%, which was up from 49% just a year ago. Also in the marketplace, one of the trends we've seen is individual investment managers offering a broader array of their target date fund suites. So while perhaps initially there was only an actively managed offering, one manager may offer a suite of target dates that has an active option, a hybrid option, and maybe even a passive option as well. And then generally in the marketplace, we have seen fee compression over the last 3 years. So expense ratios across all strategies have been on the decline. Looking at glide path allocations over time, we have noted 3 key changes within the last decade. And that is that there tends to be higher growth allocations today in longer dated funds than there was back in 2008. And there tends to be slightly lower growth allocations in the shorter dated funds, so those nearer to retirement. We also tend to see greater diversification within fixed income in particular in today's glide path versus the past. The use of long duration bonds is slightly more common, and then the use of opportunistic segments has expanded beyond just high yield to things like more non-US fixed income, emerging markets debt, and bank loans. The other key shift in glide paths has been the allocation to international equity. Over time, the majority of the providers have increased their allocation to international equity as a percent of total equity. So if we go to the next page, let's take a look at the performance of the near retirement funds in 2008, the financial crisis, versus the first quarter of 2020, so the COVID crisis that we're experiencing today. And we did a comparison of various vintages within the Mercer Mutual Fund Target Date Fund universe of 2008 versus 2020. Today, I'm focusing on the near retirement vintages because we see that as sort of the key focus here. You could argue that younger participants, regardless of the market drop, have a longer term time horizon and they can withstand a steep drop because they're investing for the long term and the market should recover over time. The near retirement funds are what can cause the most pain, specifically for those participants who are either very near, just at, or in retirement. A significant drop in assets can have a big impact on their quality of life in retirement. So what you'll see is the median target date fund today outperformed the median from 2008. So we saw a median decline of about 10.4% versus about 14% in 2008. And so we kind of think about why might that be the case? I mean, still 10% is a hefty decline, but it's a better outcome than 2008. I mentioned that the allocation to growth assets tends to be slightly less in the nearer dated funds, so that's one reason. But if you look at the table at the bottom of the page, you look at some of the performance of the key indices in the markets, and this tells us a little bit more about the story as well. So I mentioned the shift to a higher allocation to international equity as a percent of total equity. So that means in many cases that allocation to international equity came from domestic equity. And while non-US markets generally underperformed the US markets in the first quarter, if you look more granularly, you'll see for emerging markets specifically, shown at the bottom left there, emerging markets were down 23.6% in the first quarter of 2020 versus almost 28% in 2008. And then we did see that small cap performed worse this time versus last time. So if the international equity was taken from domestic equity, that kind of accounts for some of that better performance there. Also, you'll see, and David mentioned, long-term bonds was the best place to be. There are a few providers who do allocate to long-term bonds in their target date funds, and that has helped significantly. Another key difference too was the performance of TIPS in 2008 versus 2020. So 2020 TIPS performed much better than they did in 2008, and we tend to see higher allocations to TIPS in the nearer dated funds. So if you flip to the next page, I think a key question looking forward is, how will this COVID crisis impact the target date fund marketplace? Will it cause some plan sponsors to focus more on strategies offering downside protection? Will there be greater focus on retirement income and the incorporation of annuity features into the default? Will the use of custom solutions increase? The picture shown here highlights the new paradigm facing employers today and the various phases of recovery. Many employers today are in response mode, making tactical decisions, and it will take some time to become more strategic. But as we return to some form of normalcy, we expect a reinvention phase as we seek opportunities for growth. We've already seen a focus on individuals' health and well-being. Employers want to ensure that employees are engaged, happy, and ready to work. We also note that during a crisis, there's more of a focus on meeting day-to-day needs versus a focus on retirement. So that may translate into a greater focus on financial wellness and the participant experience. Is there a opportunity for a focus on short-term emergency funds? We've also already seen an increased interest in managed accounts in general. So will that result in their increased usage as a default going forward, or even maybe an increased usage of a dynamic QDIA? We also, given the passage of the CARES Act, we see potential for greater plan leakage as a result of COVID. And that plan leakage may increase plan sponsors' desires for asset retention. And as a result, that would be a focus on retirees and retirement income. Because I think on the one hand, you could say, okay, if their employers are going to be focusing on health and well-being of their current employees and making sure that they're engaged and productive at work, will they not be focused on retirees? But they also want to do some workforce management too. And if you think about retirees and asset retention, one, it's better for fees in the plan, but two, if your retirees or your employees nearing retirement have vehicles available to them for planning for retirement, then it's more likely that they will be able to retire on time, and that again helps with that workforce management. And while the future is also hard to predict, I think one key area of focus that should remain is on glide path suitability. Does the current QDIA fit the demographics of your participant base? From a glide path perspective, do your demographics support a more conservative or a more aggressive glide path? Plan sponsors who evaluated target date funds coming out of 2008 may have focused more on downside protection, and as a result, selected a more conservative target date offering, which in turn tended to underperform peers over the next 10 years, and in some cases, or one in particular, has resulted in a lawsuit because that conservative glide path underperformed peers. So we really think the key here is knowing your participant base and really taking a look at those demographics and ensuring that the QDIA that you select is appropriate for that participant base. And if it's a target date fund, that target date fund is appropriate for your participant demographics and in line with your own philosophy. Thinking through, is there a preference for a custom solution versus an off-the-shelf solution? What percent of your population is nearing retirement? if you have a large number of participants who are over age 50, then focusing on retirement income may be a key focus. And then that may gear you more towards a custom solution. Does a retirement income feature make sense? Is there a preference for active versus passive versus hybrid, single manager solutions versus multi-manager solutions? I think at the end of the day, if we know there's one key thing that works in the DC marketplace, it's that having strong governance and a focus on process always pays. And so in my view, that piece about glide path suitability and QDIA suitability in general is really key. So with that, I'll turn it back to you, Tom.
Thank you very much, Leanna. And one of the things that you brought up, which I think is so important at the very end, is the fact that one size does not fit all. And it's very important that plan sponsors understand their employee demographics and select investments that best are suited for them, and also follow their own philosophy, their own understanding. So I think that's very, very insightful, and thank you so much for your comments. So finally, we're going to go to you, Joe. And Joe, as I asked Leanna, would you please frame your remarks by stating the average plan size you advise on? And in your presentation, could you address these issues, Joe? I think you might agree that the 2008 crisis really showed that not all TDFs are created equal. What changes have occurred within the QDIA over the past decade? Have your clients been looking at managed accounts? And do you think as a result of this crisis that appetite will increase? And finally, what should plan sponsors be doing now and in the future with regards to QDIA?
Sure, thank you, Tom. So Hub advises on all size plans, but our office focuses on the small to medium size, ranging from about 5 to 400 million. So as Leanna pointed out, there are different challenges depending on your plan size, and we'll address those as I go through my comments here. But for the most part, everything we covered here, and we find that if it's happening in the mega market and then the large market, it kind of trickles its way down to the other plan markets. So this could be, all these comments could be applied to most of your plans. One of the most important and challenging and sometimes overlooked issues for committees is determining the appropriate QDIA for their workforce. Many times we find that the target date funds or the QDIA solutions are actually manufactured by the record keeper without much thought behind the appropriateness for the plan participants. So I'm going to expand on what Leanna was saying as I talk about some of those other challenges through this, but that's a real important point for us on the phone to all realize that this is a challenge, and you should probably expand your due diligence, or at least your knowledge around the QDIAs for your workforce, because that's really important. One of the points that Tom brought up is, the 2008 crisis really showed that not all target date funds are created equal. So over the past several years, we've addressed some of those changes, but what we observed is many of the target date funds have become more sophisticated within their asset allocation to offer possible techniques to mitigate volatility, while others have added a tactical component that allow them to make adjustments within the holdings to try to manage volatility. And for committees, that's often a challenge. If we're not necessarily investment experts on the committee, and I start talking about tactical components, it's really important for us to understand what that actually means, because it could have some very positive effects on your participants, but if you have nothing but a market that goes up, it could have some negative effects. So it's really important to understand that the QDIAs, particularly target date funds, have not just stayed as they were when they were first introduced. They have become more and more sophisticated as the market has called for it. In most situations, we see that as being a huge benefit to the folks, because as David mentioned, a lot of folks that are in target dates in the early stages just kind of stick with it. And what we're hoping is this sophistication within the target dates would also attract some of those folks that have larger balances or a little bit older in sticking to their plan. Because after all, the target date fund, that glide path is designed for somebody to stay in for the long haul. But what has also happened is, maybe not as a result of the crisis immediately, but what has happened over the past 5 years, we've seen that more and more clients are at least looking at managed accounts. And the question was posed, hey, as a result of this crisis today, do you think more and more plan sponsors might increase their appetite for managed accounts? And I would say the answer is probably yes, and I'm not so sure it's due to the crisis today. I think it may be a combination that more and more plans have the appetite for managed accounts to look for something different. Because as account balances have increased due to the long run in the markets, I know we don't feel that way today, but the market's been on a long run. So average account balances have experienced great growth. You also had over the past 10 years auto enroll and auto escalate. So you're finding that these account balances are growing at a point where some of our clients have adopted or at least consider adopting managed account. And that primary reason is managed accounts may provide a little bit more customization to meet a participant's risk tolerance and their funding needs. So what do I mean by funding needs? And Leanna touched upon this when we're talking about the success of the glide path. If a participant is on track to replace their income or a goal of their income, the managed account may adjust their risk downward. And if they're falling short, this managed account may adjust their risk upward or increase their risk. So this managed account may provide for different risk tolerances that basically mirror a glide path, but allow a little bit more customization based on an individual's risk tolerance. And as David shared with us early, the number of folks that self-direct increases with age, and there is a concern with that because we see them making making moves possibly at the wrong time. So the managed account may be the answer to that. And this is due to the fact that maybe they're looking for something different other than off-the-shelf target dates. Maybe they are looking for either a customized glide path or a customized solution that allows them to start defining their risk or their appetite for risk. Plus, the stats show that managed accounts, tend to have stickier assets than self-directed. So, to David's point early on, in our profession, what we do, we're looking for the way to set up folks for the highest probability of success. And if they're making the moves at the wrong time emotionally, that could hurt their chances at retiring successfully. So, these managed accounts may attract those folks because before they just didn't want the plain vanilla solution, and this may attract some of their interest. Once the dust settles from this crisis, and I hope that's fairly soon, I do think plan sponsors will be more inclined to consider managed accounts as their QDIA, or at the very least offering it within their plan. More and more of the managed accounts now allow for additional oversight for customization by the plan consultant or advisors, which may also result in greater adoption rates. So that leads us to a really good question, Tom, that you posed, and that's, what should we be doing right now? So what should a plan sponsor be doing right now and in the future with regards to their QDIAs? I would say a couple points here. First, I would really have plan sponsors scrutinize their default options by taking a view through their employees' eyes. Again, we have to be really careful that we're caught in this trap that we're just looking at pure performance or looking at the record keeper's manufactured target dates. I think we really need to look at it from the employee's eyes. And Leanna discussed how it's a good idea to take a look at the overall demographics. So some of those questions may really be, do we have the appropriate glide path for a majority of our savers? And if our population has a huge age disparity, what does our glide path, what category does it actually serve? And is there a way to have a target date series that really serves many age ranges? If not, does it make sense to then also introduce a managed account for some of those folks that may fall out the appropriateness of the glide path? So, really the question would be, are managed accounts more appropriate based on the overall account balances, the sophistication of our employee population, which is huge, and our overall employee education communication program? And let me tell you what I mean by that. The stats show that if we do introduce managed accounts to folks, they suddenly have action that they do need to take. See, offering managed account solutions does require some increased employee engagement. They do have to go in and answer a survey. They do have to take a look at this to make sure that they have the appropriate managed account solution versus the target dates. It's age-based, it's plain vanilla, it's very simple to choose from. So we really ask our plan sponsors, let's take a look at your engagement within your employee base. Let's take a look at how willing you are to allow us to communicate additional information to them. And let's take a look at the overall web usage to see if we're attracting folks, because this is not just set it and forget it for some of them. They do have to do a little bit of work for them to land in the appropriate managed account. So I'd say that's a huge point. And then finally, that would lead us to the question for plan sponsors. What do you do if we're looking, is a managed account better than a target date? And there is no right answer. I think both are very solid options, but there are additional considerations that need to be discussed if we're actually going with the managed account solutions. So again, these may not actually entail investments, which is surprising when we talk to committees about, if we're going to offer a managed account, let's not worry about the investments for a minute. Let's talk about, will your employees have the ability or desire to learn more about managed accounts? Let's take a look at the record keeper and look at how they're describing the managed accounts to your folks. Again, looking at it all through the employee's eyes, because we know that the target date funds are the easier option, even though that the managed accounts may be more appropriate. So that's really, really important. And then one last point, as we're talking about what do plan sponsors need to do now, Leanna brought up a really great point. I think it's really important to understand how you are comparing and contrasting multiple target dates even within the same year. So we saw a bunch of stats on the page, and when we're looking at statistics when it comes to target dates, we have to first lump them in a similar year just to get apples to apples, but that necessarily doesn't land as an apples to apple comparison. So we agree that the first step is to study the demographics of the plan, to include age bands, savings rates, any employer contribution, turnover. In other words, do your folks actually leave the money in target dates, or are they rolling out of the plan when they leave, and the average account balances. This will allow us to then determine the likelihood of success for a majority of their employees. And when you look at all that, as a result, we will then be able to determine the most appropriate glide path or a range of glide paths. And that's our starting point, in which we can then use analytical software to compare the performance, risk, volatility, overall statistics of the funds that fall within the appropriate glide path for a majority of your population. And unfortunately, we go into plans too often that we don't see any indication that that very important step that I'm pointing at now and Leanna discussed hasn't happened. So I think from a fiduciary standpoint, that should be the very first thing when we're looking at comparing target dates. And what this process will do for most committees, it'll eliminate a majority of the noise out there. It'll eliminate a majority of the target date fund offering and allow them to actually drill down to the 3 or 4 best choices for their specific plan. And then, of course, the more participants you have in a plan, the more difficult this task becomes, because we may have a wider range of ages. Our demographics change with the numbers. So I think it's really important at this time, and not just in relation to the current crisis, but I think it's really important for us to start drilling down on what our overall attitude is on the QDIA from a plan perspective, how we're actually going to perform the diligence on those QDIAs, and then most importantly, is the specific QDIA that we are choosing for our plan most appropriate for our workforce. And again, I presented that as a challenge, but if the committee is very diligent about working through with whoever helps them, their advisor or consultant, I think you'd feel very comfortable with the conclusion that you come to, that you are putting the best possible QDIA in for your employees. So Tom, I'll push it back to you because I think we addressed everything, and I just wanted to expand on those key points.
I think you did. Thank you very much, Joe. And I think that really shows a very important point, and that is for plan sponsors who are looking at these various and sundry requirements relative to their plan and their employees, it's very important they work with sound advisors like yourself who understand how these things work and follow the direction that your advisor gives you. So I can't stress that even more, Joe, how important it is to work with the advisor who understands the marketplace and all these various choices relative to funds, target dates, QDIAs, and so on. So I think
Tom,
what we'll do.
Tom, I'll add one point and then
Sure.
Document it, please.
Okay.
As you all know and you've heard on prior town hall meetings, documentation is really key. We actually had a client that was under investigation, and we were hired after they went through a DOL investigation. And one of the questions was, well, why did they had target date funds that were the same as the record keeper? Now, these funds were great and they passed all the screens, but they actually asked, what is the process for your QDIA? And the reason they asked that is their plan was auto-enrolled and re-enrolled. As a result, there was 92% of their employee population was just in the target date series, which turned out to be excellent for them. But the DOL just did ask, what was their process on the QDI selection and determining if that was the most appropriate for their workforce. Now, we went in and did some patchwork, and it actually ended up being, we can justify how they chose those target dates, but they did give us a blank stare when they were trying to answer that question at first. So it really is important that you document how you arrived at the appropriate QDIA.
That's good. Absolutely, Joe. And I think one of the things someone once told me when I asked them, how does a plan sponsor deal with their fiduciary issues effectively? And they said there's 3 things they should look at, Tom. Document, document, document. So I couldn't agree with you more. So I think now we're going to open it up for questions. We've got a lot of questions coming in. Unfortunately, we might not be able to get to all of them. but we'll try to at least do some of the ones we've had pre-submitted, and also we'll go to some of the questions you've asked during the presentation. First of all, go to one of the pre-submitted questions. I'll let go to you, David. And what does the empirical data show about target date investors' returns versus those who are in managed account programs like MSTAR?
So, there's been different research that's come out on performance, but I mean, here's my perspective. Both are professionally managed solutions, right? So, some research has shown that managed accounts outperform, some say TDF. It doesn't necessarily make sense that one should beat the other. There are oftentimes additional expenses to managed accounts. There's like an overlay fee, but at the same time, there's ability to use in-plan options. And so for me, I think one of the themes I've heard today is it's really more about personalization. So I wouldn't focus so much on the performance between the two, more of like how are they helping participants help accomplish their retirement goals.
That's great. Let's now go to Steph Chalk, who is our executive director of trial, and Steph has been compiling and also in conjunction with Erica. Steph, do we have any questions that have been submitted by the audience during this call?
One is, we've noticed movement, and this is coming from a plan sponsor, but we've noticed movement from an existing QDIA investment, which was based on age, and then participants in some cases are moving to shorter duration and shorter maturity QDIAs. And the concern is, do we have any responsibility / potential liability when we see this and notice that that's being done?
Joe, would you like to address that?
Yeah, I think that, so that is a concern, and I would chuckle a little bit because we're also seeing, we just had a review with a plan that has about 5,000 participants in it, and we actually saw that some of the people that moved their target date funds, they just moved half. So they may have been in the 2035 and they moved half to the 2020 all of a sudden to try to get more conservative. I often describe that concern as trying to ride a bicycle uphill with your brakes on. If the glide path is appropriate for you, it's really important to stick with that glide path, but it's very difficult to communicate that to folks. So luckily what we found is, for the most part, and I think David's statistics showed that, and Sharon also addressed this, for the most part, people are staying in their appropriate glide path, but we are starting to see that shift. And I would say, if we looked at that and we actually broke it down, they're probably doing the same thing that David showed with the older folks, where they're moving out at the wrong possible time. One thing I would say, if they're only moving down one vintage, so from the 2035 to 2030, they probably haven't done themselves too much harm. But they did get the sleep at night factor, or increase the sleep at night factor. So it is a battle we try to fight a little bit, but I'd rather have them move within vintages than move into cash.
Great, thank you, Joe. Now coming to you, Leanna, will the crisis, this is one of the pre-submitted questions, will the crisis be a catalyst for plan sponsors to begin to look for more sophisticated target dates that focus on downside protection?
So, I covered a little bit of this during my remarks.
Right.
I think for those participants looking at their target date funds and evaluating whether it's appropriate, anytime you're coming out of a market downturn, after a prolonged bull market, it's sort of just a reminder that the markets don't always go up. So I think, there's probably more attention being paid to what is the downside protection, and, looking at the, overall glide path and how aggressive or conservative it is. Again, I think suitability is the key, and I don't think necessarily plan sponsors should, reevaluate and move to a more conservative glide path just because it offers downside protection. Again, I think it's look at the participant demographics, look at your population, and determine what's most suitable for them. And then you also want to get comfortable with how the defensive assets are being managed within that glide path. And there are some strategies that have more sophisticated kind of downside measures that are, incorporated into that strategy. And so maybe there will be, more focus on how is that downside protection offered. There could be, if it's a custom solution or even some off-the-shelf may incorporate some kind of low volatility equity strategies, or there could be some long short equity component, which can provide a little bit more downside protection. So I think, under the hood, plan sponsors should look to see what's available. But again, determining whether you should have more or less downside protection really comes down to suitability in your participant demographics.
Great, thank you very much, Leanna. And now, Steph, let's come back to you for questions from the audience.
The question is, why are the older workers leaving the defaults that they've invested in? And the question becomes, is the risk in target date too high for them? And should these changes be made, or should sponsors select glide paths that are different from what the workers are looking at?
Sharon, would you like to address that?
Sure, thank you. Well, I think you have to look at the overall cohort of 60 plus, where there was more of a flight to safety, whether they were in a QDIA or a target date solution. I think it comes down to perhaps participant education at that point, and as everyone on this panel knows, no two target date solutions are the same, even as you approach retirement. So I'll go back to what Leanna said, which is you really need to make sure, and Joe talked about it as well, that when you're looking at the QDIA, assuming it's a target date type solution, that you're looking at the demographics of your plan in order to make sure that you have the appropriate set of series. I just think it's just human intuitive nature, unfortunately. And the last thing I would say is if we get some type of guaranteed income to help all participants, particularly pre-retirees, understand that you're locking in some of that guarantee, my hope is that that will help.
Great, thank you very much, Sharon. Now, another question we have is, do you feel there will be changes to the glide path given market volatility and the CARES Act distributions? Would you like to address that, David?
Sure. And maybe one quick thing to the last question. I've done a lot of research looking at who makes changes, and I think a big thing is goal salience. People don't actually know how risky a TDF is. The average person has no concept of what a 30% or 50% equity allocation is. I think they just know they're close to retirement, and they just panic, right? And we saw this back in 2008. It's happening today. But with respect to your last question, I mean, we already have lots of glide paths out there. I mean, there's over 100 strategies that exist today across the mutual fund in CIT space. One thing I'd like to see is more providers offering more options in terms of glide path risk levels. I think what you most often see is companies creating different types of strategies. So they'll have an active strategy, a blend strategy, and a passive strategy. I'd like to see more risk levels for different companies so that an organization that wants to have, for example, a very conservative glide path doesn't just have to pick among those available. They can say they want to go with a certain organization and then figure out which risk level of those that are available they most like.
Great, thank you very much. Next question we have that was been pre-submitted is how do you feel the usage and effectiveness of managed account program as QDIF versus TDFs? Joe.
Yeah, sorry. So again, I address this a little bit by saying, if you get the suitability down first, that's the first and foremost. But I think the managed account actually takes more effort and commitment from the plan sponsor. Now, I'm not trying to scare anybody away from the managed account, but the fact of the matter is it is a little bit more difficult for an individual to land in the appropriate managed account than it is in a target date fund. Simply one is age-based and one is age and risk tolerance-based. So to address David's points, a managed account may offer that glide path type allocation and also allow an individual to choose their specific risk levels within that glide path. So that could be the answer. The custom target dates could be the answer because that does that well. But I do want to stress the commitment from the employer or the plan sponsor that it does take a little bit more effort. Now it's worth the effort, but it does take a little bit more effort to educate employees on the appropriate managed account solution for them.
Great, thank you very much, Joe. Now, Steph, do we have any questions submitted by the audience that you'd like to cover?
Yes, we do. The one question, very direct, is the difference between the target date and the managed accounts, and is the additional expense on the managed accounts worth it as opposed to going into a target date fund.
That's sort of a follow-up to both you and David. Joe, you and David, your last comments. And Dave, would you like to comment on that?
Yeah, I mean, I think the answer is it depends, right? I mean, I don't know. I mean, like the fee range for managed accounts, it actually is free for certain providers, and it can be over 80 basis points. I think that where the fee makes the most sense is among participants who derive the most value. And I think that, you know, one example is that, you know, among older participants, you know, managed accounts is going to do a better job keeping them in the service itself, but also give them information about, you know, things like, are they on track to retire, when they should retire, what their withdrawal should be. And so I think that, you know, from like a default investment space, you know, using them in a dynamic or dual or hybrid QDIA, where younger participants use the TDIF and older participants use managed accounts is a pretty smart way, because it does appear that older participants do generate the most value from the personalization.
Great, thank you very much. Well, unfortunately, we've run out of time, ladies and gentlemen. And as I said at the beginning of asking the questions, we've received a large number of questions, so we apologize if we didn't get to your question. DCEA, TROW, TPSU, and Spark will continue to have crisis-related webinars, and look out for more announcements and offer additional resources linked at the end of the presentation, as you see right here. Here's some resources you can turn to. I want to thank all of you for attending. I want to thank all of our panelists. I want to thank David and Sharon and Joe and Liana. Great job, and we appreciate your participation. I hope all of you that are on the call today, you are safe and healthy, and all your families are as well. For those of you who wish to receive either the HRCI or the Spark credit, I'm sorry, the SHRM credit, please stay on for an additional minute, and we'll come back and give you the code necessary for you to fulfill those credit requirements. So again, thank you very much. Stay safe, stay healthy, and we'll see you again at another upcoming town hall. Bye-bye.